Welcome to Roaming Returns, a podcast about generating a passive income through investing so that you don't have to wait till retirement to live your passions. Ever confused which sources give you quality investing information? Yeah, there's a ton. Tim subscribes to many and outlines the best ones in today's episode. Tune in to see which two he recommends specifically for newbies. And don't worry, most of these are free, so you can put your hard-earned money into investments. Let's dig into specifics.
What up?
Hey guys.
If you've watched the market the last week, it's been a shit show because everyone's panicking that, they may not raise interest rates until September, or they may not at all. As contrarian value investors, well, I don't really give a shit. Neither should you. More shares at a lower price.
But this is what happens. Life doesn't go according to plan, so you have to plan for the worst, hope for the best, but plan for the worst. That's why income investing is the best approach, because as the markets go down, you just pick up more and more shares, and when things turn around, you make all that value back, plus all the dividends in the interim.
Oh, you're wise.
We should update them on what you were talking about this morning with Tesla.
I liquidated the TSLY
Yield Max,
and I put it into YMAX because Tesla's just garbage.
For whatever reason, that specific one is not managed in a way that makes sense. And we have a sneaky suspicion that it's going to do the same thing it did before, where it's going to drop down. They're going to have to do a reverse stock split.
Give you less shares.
So it's just going
to prop the price up.
Head to zero.
So literally you're just going down to zero.
So we took a $1,200 loss in that?
$1,200 loss to get it back. So we're still getting yield max income because I put it in the Y max, which is basically every yield max they have goes into the Y max, and I figure that's the least riskiest of a risky invest.
Yes.
And
the reason that
that's how I sold it to myself.
The reason that Tesla's being all stupid is if you actually follow Tesla stock, they had a bunch of news come out.
Bunch of not good news. Like their sales are down in China. Their sales are down in America. They had to recall their trucks because of this accelerator sticking, which I guess is never a good thing if this accelerator sticks.
Probably not.
Their margins are shrinking, and they're currently probably going to court over whether or not to give Elon Musk some compensation. So, it's just going to be a show for a while. So I figured I'll just take a little bit of a loss to not have to deal with that. I mean, we still have exposure to the Tesla Yield Max and the Y Max, so yippee.
And I think one of our other funds also includes Tesla in it, which isn't a big percent, so it's not that big of a deal. But Tesla hit its 52-week low. If you look at that chart, open up that baby in Yahoo Finance, it is on the downward trajectory. And usually if it breaks through its 52-week low, it's going to drop further. So for those of you who have that or interest in that, that might be fun to watch play out.
As long as you don't have shares, it's fun to watch play out. If you have
but this is why we do not own Tesla.
If you have shares, you're going to be dealing with that emotional bias. So, oh my God,
well, and what goes up sometimes comes down, and I think Tesla's been overvalued for a while, so it's correcting back to wherever
the mean.
I don't know. It is the mean.
Anyway, we are completely off topic, as never has happened before. I just got talked to about that. She's like, the last one she was at, she's like, you realize you're all over the place. I'm like, yeah, that's how my mind works. Deal with it.
All right,
thought you loved me for me. You don't?
Of course I don't love you for you.
Today, one of the questions I get from a lot of people, whether it's an email, get your hand out of my face. Whether it's an email or if it's in person, is where do I get my research? I mean, I'd like to take credit being this smart, wise man that I am, but I actually do a lot of research using other people's research, because I'm able to get more information in a quicker amount of time.
Yeah, that's the thing. You can't be everywhere at once. You can't see everything all the time. And if you sub things out or you rely on certain reliable sources for specific things, they go dirty.
It's not like I'm not delegating it to an underling, which would be hilarious. Underling, go research.
That may happen at some point, though.
It never will. I don't the research has to be done by you. If you've done. Because they would come back with research. I'd be like, this is all wrong.
Well, so based on that, Tim uses these other resources, but he goes and you double check it. You think about it before you implement anything, right? You just don't take that word for it.
Anytime I any resource that I use, I research with. They have an article or they have a portfolio or they have like a blurb or a text or an email or whatever. I'll actually go in and do my own individual research. I don't take any. Again, nobody cares as much about my money as I do, so I don't take anybody at their word. I do the research to make sure that everything's good.
But they put him in the right direction, or they give him things he might not have caught.
Or what happens a lot of times is they'll be talking about, like, say, example, for a closed-ended fund, they'll be talking about, like, let's just hypothetically, a utility closed-ended fund. Well, when I start doing the research, I come across like 12 of them. So then I'm like, oh, rabbit hole. So I have 12 to research because their one might not be the best. So then I'm like looking at 11 others and I'm like, well, I like this one better. This one's holdings are better. Its diversification's better. Its beta's better. Whatever the case may be. So it gives me a starting point, and then I deep dive from there.
So this catches a wide net, but it also helps you narrow focus and save time.
I just tried to narrow it down to like the ones that I think an average person could use and benefit from. So the first one that I use a lot is it's called the Dividend Hunter. The guy that writes it his name's Tim Fallon. He, as he likes to say all the time, is he flew helicopters in Vietnam or something. I don't know. He talks about it all the time. This one's a paid one. The first couple are going to be paid subscriptions. I paid for it for a lifetime membership.
What does the helicopter thing have to do with anything?
Because I don't know.
It's just his like marketing thing.
So I guess he's good making decisions under pressure or something. I don't know. I don't know what the flying thing has to do with it.
Nice.
But like he's kind of cool because he travels around in an RV like part of the year, and then the other part of the year he's in the office.
Oh, so he's similar to us.
But what he does is he looks for high yielding. When I mean high yielding, I mean like 6, 8, 10, 12, 14%, not high yielding like all the other experts.
2, 3,
high
4.
yielding's like 4%.
Yeah.
So he looks for the high yield, and he talks a lot. But like if you can get through all the talking, you can find different things to look at. If you pay for the subscription, you'll actually have he has, I think, one portfolio he has, but then he also has if you're just starting out portfolio, like he lists like 3 stocks that as an income investor, you should pick up. He also has a stock of the week. I use that stock of the week. I don't think I've actually ever invested in any of his stocks of the week, but like they give me good ideas to research further. But it's reasonable. So it was $79 for the lifetime subscription. I mean, I think he has more expensive stuff, less expensive stuff. The problem I have with him is he spams you a lot. Like I'll get emails probably 2 or 3 times a day where he's trying to sell another subscription, subscribe to something else, or he words it a lot like, well, get this dividend stock before it goes ex-dividend on Friday. And he does that a lot. We'll get an email on Monday, Tuesday, Wednesday about his stock on Friday going ex-dividend. It's a lot of spam.
I will tell you that. So what I would probably do, because I've fallen prey to this and my normal email got totally gunked up with this type of stuff because they do get very spammy. They want to sell you packages. The crypto stuff's really bad. Not that we're going to talk about crypto today, but I highly recommend getting a finance investing dedicated email for these types of subscriptions because it'll just keep your personal inbox clean, because Tim gets so many, like hundreds a day.
And he does have a lot of special reports that are nice. Like he has a special report on Main Street Finance. He has a special report on Hercules Capital. So there's a lot of nuggets to use. And you'll see, like, once we go through all these, you'll see like how if you put them all together, you have a wide swath. The second one I use is Utility Forecaster. I use this one more than the Dividend Hunter. The Utility Forecaster is all utilities. That guy's name, I don't know what his name is, I forget. But
Irrelevant.
He talks about specific utilities. But then I think it's Nathan Slaughter, if I recall correctly.
How could you forget a name like Slaughter?
I don't know. It was about $200 for a lifetime subscription. It's all about utilities. You have access to 2 portfolios, a growth portfolio and an income portfolio. The difference being income is obviously you're just getting income. You're not worried about growth, whereas the growth portfolio is a growth portfolio, but it also has, they all have dividends because they're all utilities. I think the caveat is they have to have a growing dividend. But what I really like about this one is he compiles data on every utility. So like when you go into the spreadsheet, you have access to all like 400 utilities. You can literally scroll through, and he has it broken down into like a yield, a dividend security, recommended buy price, whether you should buy, hold, or sell. So you have all that. So it's a really good starting point for everything utility. Then we're talking everything like that includes like media companies, that includes like towers, REITs, telecommunications. Like they have a lot of things that they classify as utilities.
Oh, that's interesting.
But it's really nice because each month he has a how they rank category. I don't know what his criteria is, but he'll force feed stuff in, and they'll give you a list of 10 investment ideas for that month that are ranked 1 through 10, like where he would start. Like if you're just starting in investing, say in March, you just decide I'm going to start investing in March. If you looked at this, it'd have a how you rank for March, and it would have 10 stocks to choose from.
Oh, that's really cool.
But like I said, this is a lot of data on a really big section of the market that you then have, like it literally is just in a list form. It's really convenient. Really
that kind of
awesome.
sounds like what you do in the email a little bit for the weekly going ex dividend, but you rank them in the top 10 from our value and income investing perspective.
Yeah. So like I
can see why you like that.
I actually stumbled across that myself. I actually was doing that before I actually subscribed to this, but it just makes it easier for people. Okay, well, 1 through 10. And then I'm like, I obviously in the email, I give a blurb about which ones I like that week, or which ones we hold, or which ones we've previously held. Yeah, like I said, I mentioned that they have a recommendation on each and every utility investment, which is super nice.
Like everyone, comprehensive, like thousands.
Not comprehensive, but like I said, like if you pull it up, it's literally a chart of hundreds of utilities, and it literally has the ticker number, the price, the yield, the dividend security, buy, sell, hold recommendation, and if it has a buy recommendation, it actually has a target price that you shouldn't buy above.
Oh, that's really, really nice. And utilities are great if you guys have listened to the utilities episode for all types of investors, whether you're risk prone or the more the risk averse.
The reason that I was okay buying this one for more than a couple dollars is because I plan on having utilities in every portfolio until I die.
They're recession proof. They're a hedge. They're safer.
They're always growing. They generally grow between 4 and 10% per year. Their dividend.
Mm-hmm. We talked about that in the utilities episode.
So it's nice. The third one is called Sure Dividend. I was using Sure Dividend for a couple years, the free version, and I finally upgraded to the paid version. I think 4 months ago. It was $79 a year. I probably won't renew my subscription, and I'll explain to you why. Well, the only difference between the paid version and the free version is the paid version gives you a deep dive into the 10 investments that they think are the best for that month. So like at the beginning of the month, you'll get an email saying this month's issue is available. You go into the issue, they'll have the 10 best investment ideas for that month, and they do a deep dive. When I mean deep dive, I mean deep dive. It's very technical. Very hard to read if you don't like to read technical stock investing stuff.
And that's coming from Tim.
The research you get, like, for example, is EPS growth, CAGR growth, 5-year price prediction, payout ratio, fair value price, dividend safety, estimated annual return, et cetera, the number of shares they have. It's very, very thorough. But if you actually use the free version, that you get emails probably, I want to say 3 to 4 times a week about ideas. And I know you get one email at the end of the week that gives you like stuff to read over the weekend, and you get a lot of the same information in the free version on the weekend. So like they'll say the best dividend aristocrats, and they'll list the 10 best, and they have all that information that you pay for. So there's really no incentive to spend the money. So I feel kind of stupid that I spent the money, but I guess GTK, I don't know.
Well, if you look at it from the perspective of these couple of, less than $100 for these two, and the one's a lifer plan, what are you spending on a financial advisor?
I understand that, but like
you could equate it to that if to get started.
If you research your stuff individually rather than just take people at their word, you're getting the same information. You just have to go through a couple extra clicks. So,
but I'm saying for a one-off,
if you're okay with paying for a couple extra clicks, I guess. I'm telling you, if you pull it up, like they have a list for a lot of stuff. And like, if you go into it, that's where I got the idea to invest in 3M long before I actually subscribed to this, because 3M was on one of their dividend growers or something list. And I looked at it, I was like, well, all that data looks good. Like, it is broken down nicely. Like we'll say a current price and the consensus or estimated price that it should be. So it gives you like a break, like you can just tell like right away without even having to do like a PE research or a peer research, anything of that nature. It'll just tell you right away that 3M was undervalued by like 50%. But then it also goes into everything else about 3M, and it was all for free. So I don't know why I paid for it, to be honest.
How do these resources compare to the screener tool? Does this give you different information that obviously wouldn't show up in the screener? Or is this kind of more of a moot point because the screener, since you've developed it? The
screener gives you an idea, whereas this gives you details. Like the screener, like literally only has 4 different things you look at.
Well, I understand that point, but I'm saying this is a different way to get ideas versus using the screener tool?
Yes.
So you're using 2 separate ways because obviously they don't all capture everything for each way?
Right.
Yeah, okay.
And then when you do a screener and some of the same investments show up, you're like, oh, I must be onto something.
Okay. So it's like a backup, a affirmation.
The 4th one is simply Wall Street. I have not subscribed to this one as of yet, but I plan on it in the future. The difference between the free and the paid subscription in this one is if you do the free one, you only get you can only do a deep dive research on 5 stocks per month, whereas if you do the paid, you can do up to 20. This is for whenever you are really comfortable with your screening, where you actually have an idea of, well, I like this one, I like that one, I like this one. Well, you can just plug the ticker number in, and they do like it's a really deep dive research. I think more so than Sure Dividend, but it's not as technical. Like it's all in pretty pictures and charts and everything.
Oh, I like that. I hate technical writing.
And with the free one you can, like, if you have a current portfolio, you can plug the portfolio into a portfolio monitoring tool for free. You can do one. If you do that, you plug in your portfolio, then anytime you have like an earnings date or a dividend date or an ex-div or any news from the company comes out, they'll actually give you an email at the end of the week saying, here's what went on with your portfolio this week.
That's really cool.
And you have access to all that. But when you pay for it, you can do up to 3. I think they cap it at 15. It might be 10 or 15. I don't know. I don't remember the exact number.
10 or 15 what?
So if you do the free one, you can have a portfolio of 10 or 15.
Stocks?
Yeah.
Okay.
If you do the paid one, you can have up to 45. So we need the paid one.
Okay. I see why you want the paid thing now.
You get the valuation. They have like a estimated fair market value price. They have what it currently is, how much it's undervalued. They have an in-depth look at the PE and the PE versus the peers. They have an in-depth look at the financials, so it's good for that regard. If you say you don't have Schwab and you're in one of those other ones, then you don't have access to the
really
financials
awesome.
Like Schwab has.
Really
so
awesome
then
tools.
you're going to need to find a place where you can just plug a ticker in and it gives you all the financials.
You're going to need a third party if you're not using Schwab, basically.
In my experience, but I haven't used Fidelity yet.
Yeah, Fidelity may. Again, we talked about that in last week's episode.
So it might. Now we're going to get down to the important stuff. If you're just starting out.
You want free if you're just starting out.
Free so you can use your money to invest with. These are all free ones from here on forward. Out. The first one is Contrarian Outlook. This literally is everything closed-ended funds.
Literally?
Literally. His specialty, his name's Brett, I think it's Brett Owens. His specialty is closed-ended funds. Like he is like the go-to source for closed-ended funds.
And you know how much we love those. Every
day you get an email with a potential closed-ended fund to purchase, or sometimes 5, it depends. But every day you get an email with like 1 or more closed-ended funds that he thinks are good. He gives you a pretty easy-to-read breakdown of why he thinks it's a good one. They have a paid one as well. I actually did sign up for the paid one. The difference between the paid one and the free one is literally just his portfolio.
Which isn't necessary if you're starting out.
And that's why I think the free one is just as good. But if you do the paid one, the actual portfolio is nice because it, again, has it broken down. Like, don't buy above this. Like, this is the highest that you should buy it. But if you've ever done any research on closed-ended funds, you know how infuriating they can be because you never know if they're, like, priced right. I mean, again, I hate to and keep it beating the drum. But in Schwab, if you click on a closed-ended fund, it tells you at the very bottom of the ticker page that what the historical NAV price is, like if it's historically a premium or a discount, the 1 year premium or discount, and then you can make a determination from there if it's undervalued or valued right, or if it's overvalued. Contrarian Outlook does that as well. So if you don't have access to a brokerage that just tells you right away that, hey, this is 5-year discount of 18%, a 1 year discount of 14%, well, then you can go to Contrarian Outlook and he'll actually inform you of that.
Nice.
The second one we've already mentioned was Sure Dividend. I honestly think that you should have subscribed to Sure Dividend just for the free one. Like I said, this is where I got ideas for the utility stocks. This is where I got ideas for the dividend contenders. This is where I got idea for REITs. This is where I got idea for BDCs. Like, they come out with a list of the top 10 whatever pretty much every week. And then if you do the weekend readings, like the last one I got was 18 weekend readings. It did, it had lists of the REITs. It had lists of the BDCs. It had list of the low volatility, high yielding investments. It had a list of the best monthly dividend paying high yield investing. And then it did 4 deep dives on dividend aristocrats. So every week you'll get a list of a lot of stuff to read over the weekend. And it's all pertinent because it literally is just like the paid subscription, other than they have in the paid subscription, they have a nice graph, like a nice picture of the dividend yield plus the price. And if you know anything when it comes to investing, you know there's a dividend magnet. It's a theory that I think Brett Owens said. But if the dividend should be in lockstep with the price, so if there is a discrepancy in the dividend yield and the price, if it opens up, then you know the dividend is going to pull the price up. But if the price is well above the dividend yield, the price should depreciate until it gets in line with the dividend yield. It's an interesting phenomenon. I might actually need to do an email on that at some point.
I've actually seen that in a few of the investing books that I've seen. And that's what they'll do, is they'll actually follow those dividend price gaps, and they'll buy in and sell depending.
If you don't know about that, I should be having an email about that coming out at some point, where it actually is a very quick and easy way to determine if something's a good buy based on the gap between the price and the dividend yield. We mentioned Simply Wall Street. The next one is Investors Business Daily. I get an email, at least one a day, from this resource. The only problem is you can't actually control the topics, but you get a lot of ideas from them, and they don't take very long to get through. Like, they gave me the idea for DSX was this morning's. Yesterday was some REIT, I forget, but like, you'll get an email every day of saying this is a good high yield investment to research. And then you just literally click onto your brokerage, type in what they're recommending, look through it, and say, well, is that a good idea or not? So like, you get an email every day, though, all 7 days of the week. You get an email saying this is a potentially good investment to look at.
How many of them do you actually agree with?
4-ish.
4 of 7?
Yeah, a week.
That's pretty good, actually.
And then you'll see, like, there's 2 different authors. One's John Whitfoot, I think, or something like that.
Whitfoot?
Something like that. Like, he's probably a third of the time I say, well, that's a good one. But there's another one that's really good. He does like a pretty thorough. Do
you know his name?
No. The one that I used for years and years and years and years was Yahoo Finance. And you just click on Yahoo Finance. It's all free. And they have so many different articles every day.
Tons. Sometimes it's overwhelming.
Where I find the potential for a lot of good information is in the comment section when people are discussing the article. Say, for example, you're reading an article about the difference between AT&T and Verizon. And the article discusses it, but you go to the comments and then people are down there discussing the article, and then they'll start giving their 2 cents about the differences between them. And you look at the comments and you're like, well, that makes sense. Let me research this further. Or that doesn't make sense at all. This person's just a hater. Like in anything, the comments are how the average person sees things. So it's very helpful to, like, when they're saying, oh, I hate AT&T. I hate AT&T. Well, that's a good indication that perhaps you should be buying AT&T. That's why when I had the the choice for her mother's retirement to buy Verizon or AT&T, I read an article on Yahoo Finance that discussed the differences between the two. At the time, Verizon yielded, I think, 7.3 and AT&T was 7.1. But I went to the comments, and most of the comments were about how they hate Verizon and AT&T is the better stock. So I was like, as a contrarian, I want to buy what people don't want to buy, which was Verizon. So that was like one of the leading indicators why I went with Verizon over AT&T.
And that actually played out really well for our favor in like shortly thereafter, didn't it?
Yeah, Verizon was up like 30% because they reported their earnings and the earnings smashed it. They just reported earnings this morning and they were pretty good. So
now that one thing won't work all the time, but I assume it's a cumulative gut instinct.
Well, if you combine all of these together, you're going to be just fine. Like this, I understand this is a lot of resources. And as I said at the top, this isn't even close to all of them that I use.
Well, and I was going to say at the end, but I guess I'll throw it in here. Pick one, get started, start immersing yourself. The only way that you learn is through small snippets over time. And then you'll notice that your prowess and your understanding and your information and your comfort, confidence and all those things get better over time as you actually start taking this information in. You get immersed in the language, you start understanding the terms, you start actually talking like this, you get more confident in what you're investing in, you start getting those intuitive insights because you're exposed to so much different information and you start to see patterns and you start to have these, like your subconscious will actually retain some of the stuff you may not consciously and you won't know why you feel pulled in a certain direction. Got to double check that that's not a bias, but a lot of times it's instinct and instincts tend to point us in the right direction, like with what Tim was just talking about with Verizon and AT&T. I mean, I think some of the metrics mashed up. He was talking to me about it from what my memory recalls, but I think I agreed with him. Even though it was a higher price, which is usually something we avoid, that like the metrics just lined up in a way that one made more sense.
And FYI, I hate Verizon.
Yeah,
but
I agree.
I'll make money from them. I can't stand Verizon. I can't stand AT&T.
I was going to say, it doesn't matter. It's a drop in the bucket.
Okay, and the last one is probably the best one. It's called Dividend Channel. It's literally just Dividend. Is it Dividend Channel? It's dividendchannel.com. It has everything. Like legitimately everything you could ever want from stocks, bonds, ETFs, CDs, preferreds. And this is where I go for my preferred stuff because they have just an awesome preferred screener. In this one, you can actually use their screener and you can pick the criteria that you want. Like say you just want to look up closed-ended funds that yield 8%. Well, you do that. They'll pull up a list for you. It has so much stuff. Look at all this. Top 10 high yield baby bonds. Top 10 oversold dividend stocks. Top 10 stocks going ex-dividend this week. The best high yield stocks.
What the heck is a baby bond?
It's a little bond.
Oh, okay. I thought they were talking
best
about
high yield stocks 2014 through 2024. It has everything that you could possibly want. It's a lot of this one.
That could be a lot too much over.
A lot of reading.
Overwhelm for people.
But if you like making money, you'll learn to like reading. So there's three big ones. The first one is the preferred ones, which I mentioned. The second is the ETFs, which I mentioned, and the third is they have a link for insider buying. If you're not familiar with that, that is when people in the company buy the stock of the company for their own portfolios. They have to disclose that. And this one has a really good way of finding out what companies are buying their own stock. And if you don't have the common sense when it comes to investing, when a company is willing to buy its own stock, that's a huge good sign.
That means that they definitely believe in what's going on.
This one is mainly the preferreds and ETFs. I can't even describe, like if you just click on the list, it has like a slide, they call it a slideshow. Like let's just do best dividend stocks 24 through 2024.
Click for slide 1.
Click, and it tells you all this stuff. Look at this. It gives you there's everything you can need. Stock price, in price, in number of shares, total return, current yield, dividend yield, how much your would have grown had you just invested $10,000 in it. It would have grown to $274,000. It gives you the website for the company. It gives you so much, like they give you everything you could possibly need. It's not too demanding once you get into the actual break, like the hyperlink for the different lists.
And it's actually very clear and concise in like almost like a chart type thing. So if you get overwhelmed by a long written word, this is like a snapshot with like almost like a chart, which is really nice.
Okay, and the reason I like this one is for the preferred. If you click on the preferred, it's at the very top. You click on the preferred, it'll pull up all the different relevant topics for preferreds, and then whenever you click on one, it'll actually pull up all the preferreds that PSEC offers. Preferred A, preferred B, preferred, I guess just preferred A at this point. It gives you the discount to liquidation. That means, we talked about preferreds long ago, if it starts at 25, you want to be paying less than 25 for a preferred share just in case they call it back. If they call it back, they'll call it back at 25. So if you bought it for 27, you'll lose that $2 per share that you buy. Mm-hmm. But then it gives you the current yield, gives you the date it went ex-dividend, it gives you the date that it will be called back. It'll tell you if it's convertible or cumulative. And it'll give you the information about the parent company, which I find is very important. Like it's very difficult to find a resource where if you're researching a preferred, it shows you the data for the company that offered the preferred. So in this particular instance, we're looking at PSEC, P-S-E-C. They have a preferred share of A, so it's PRA A. But it tells you all the information of the parent company, like how long they've been paying a dividend, their EPS, their market cap, their 52-week price gap. So you can then say, well, this one doesn't look that good because their EPS is negative 0.43. So this would be a bad preferred to buy. So that's why I said this makes looking up preferred shares so easy. And as a newbie, when it comes to income investing, you should have, I want to say, probably 10% of your stuff in preferred shares just because they're less volatile and you know what you're getting into. Like if it's a preferred share of $10 and you're getting it for $6, you know you have a potential for 40% increase in price while collecting the dividends. The problem is whenever the parent company raises the dividend, the preferred share doesn't go up, so you're not going to get the dividend growth. So you wouldn't look for preferreds for like 3M or utility companies because it's
the ones that consistently grow. You wouldn't look for the preferred.
It's better to actually have the stock because you're getting the dividend yield growth.
But for the other ones, or if you're looking for the little cut down on the risk of them potentially cutting the dividend, these are a good option.
And this is where I found QueerTep, QRTEP. I found it in here. At the time, it was trading at like $30 per share when it was originally $100 per share.
Holy crap. Are you serious?
So yeah, it was a 70% discount. I mean, the parent company is not worth very much, but like they don't like their
that's insane. And that's actually one of our best growers, isn't it?
Yeah, their price is only like $1, but like everything else was fine. Like it didn't have a dividend, but its EPS was good, its PE was good, its market share was good, like everything. The only thing it doesn't have that I wish it did is they don't have a tab for short interest. And short interest is important when you're investing. I never actually discussed this, but if you're in, say, a stock that has like 20% of the people holding the stock are on the short, that's bad.
I'd actually be really curious to see where Tesla's floating around with a short interest.
Because what a short is, like generally speaking, shorts want the price to decrease. That way they can make money.
They're betting on it going down. So the more people that have short positions, interest or open, meaning they're trying to actually push the share price down. So for us, that's good to know because then we don't want to buy if it's going to potentially go down. We want to wait for it to go down.
And again, not to toot Schwab's horn, but like if you go on the page, it actually tells you on the right column what the short interest is in any investment that you're looking at.
Now, is that only for Schwab or is that across the board?
It's the only one I've seen.
I'll have to look into that.
And TD Ameritrade didn't have it. Vanguard didn't have it. Robinhood certainly doesn't have it. So it's crazy. Like that's a huge thing that I've actually never addressed. So that might be something else I need to address at some point in an email. Is the short interest in a stock. Just like insider buying is a very good bullish indicator, high short interest is a very good bearish indicator. What's interesting is when there's a lot of insiders buying a stock that has a high short interest, and it's like, well, what side's going to win?
Yeah, watch those. Grab some popcorn, watch that stuff go down.
What I generally do in that case, because that actually happened with ABR, is that insiders were buying it hand over foot when it got below $13, and they're still doing it because it's still below $13. And there's the short interest has increased up to like 5 or 6%. I generally side with the insiders because they know the company and they know what the company's worth. Whereas you might have to endure like a volatility and a price depreciation in the short term. Long term, you should be fine because the insiders know what's going on. So I generally side with the insiders whenever there's a conflict of interest like that. Not
that makes sense. Except for that case where, what was that stock, that movie we just watched?
Dumb Money?
Yeah. Oh, GameStop, the GameStop stock, where they got a collaborative of the individuals, so they were actually coordinated on the personal front, and then they actually were able to overtake or sway the institutions to go the opposite direction. Now, that very rarely happens because it's hard to organize enough people to make that happen with those big wallets that the institutions and stuff have.
Okay, so in conclusion with our resource stuff, the two that I would pick up, I would subscribe to Dividend Channel and I would subscribe to Contrarian Outlook, both the free versions, because you're going to be covering your closed-ended funds pretty handily with the Contrarian Outlook, and then the Dividend Channel, you can research anything else. Like if I give you recommendations, or if you subscribe to email, you get the top 10 investments every week that I think are the best value to think about. You can then plug that in the Dividend Channel and you can look through it and be like, okay, that one's good, that one's bad. So I'd subscribe to Dividend Channel, Contrarian Outlook. They're free. That way you can use your money and actually invest it. You don't have to worry about spending anything. And I would actually sign up for my email if you haven't, because you get 10 really good, majority of the time, probably 3 out of 4 weeks a month, you get 10 really good, really good undervalued investments. And then you get 1 week where it's 6, and then I have to plug in 4 to make the 10, and the 4 kind of. But
why would you do that? You should just leave it 6 at that point.
Nah, 10.
Do you distinguish which week that is? Oh, he does. He is very upfront when he's like, this one's not that great.
Yeah, I'll just tell, I'm pretty transparent. I'm like, this list we just had last week, there was only 2 that I would have invested in, PSEC and SCD. And then other than that, Clorox maybe, Lowe's maybe. But I gave you a list of 10 to look at. I break it down. I use all of my resources to have a list where it gives you the yield, the profit margin. Profit margin is important because if it has higher profit margin, that means it can keep raising its dividend or maintain its dividend. And then I give you the PE of the company versus the PE of its peers. That way you can see if it's undervalued compared to everyone else in its sector. So I give you everything. Like I said, it's very simple once you actually subscribe to the email.
He gives you the most efficient information. And if you are overwhelmed by the amount of resources and possibly going through all the research and data yourself, Tim synthesizes all of those sources every week for you and puts it through his lens of what's important.
Then I give you 10. I think any person that wants to make passive money can do research on 10 different companies.
Yes, that's definitely a lot more manageable than hundreds. And going through hundreds of emails. Because I can tell you how many emails you delete every day.
Hundreds. I get hundreds of emails.
And I know I get spammed with crap.
So
I'm so bad at keeping up with my email.
So
I think I'm up to
part of the reason
46,000.
that I actually went the route I did with this is because I didn't want anyone else to actually have to go through as much crap as I have to go through to get to the
information?
To get to the same point. So I do all the
legwork.
Heavy lifting for you, and then I give so then if you just have a couple websites that you can use to research, or your brokerage to use to research, I give you 10 options. You can do it. 10s.
And baby steps. Literally one at a time. The more you do it, the more comfortable you'll get, the better you'll get, the more confident, and the better investor you'll become in the long run.
But I think if I'm interpreting what people are asking when they ask about this, is they want to see how knowledgeable I am, and I'm pretty knowledgeable. I'm not I don't have a degree.
Who cares?
In financial planning. I mean, I could. I was looking at it. I was like, it's not that difficult. But why?
Yeah. Why bother?
Why bother?
Because then I feel like you might be restricted to what they deem as worthy credentials or worthy things you can do. And because what we notice with the media and the financial, what are they called? The experts in the news and stuff, they can't actually say something is a good company until it hits or checks 10 boxes. But by that point, it's overbought and the price is too high. So for us, we'd rather have the freedom to be able to say and suggest things. Yeah, it's that is a huge thing that I've been bitching about for years now. When the experts say, hey, this, for example, I just read that email saying that SPH was a good buy. SPH, if you're not familiar, is it's a propane company in the Northeast. They literally just
deal in propane. They are a dividend, I want to say, contender. It's been like 20 some years of a dividend increase. We had it for like a year in her mother's retirement, and I sold it because I was looking at the utility forecaster, that one source that we mentioned previously. And in the utility forecaster, its EPS had went down the last 3 years, and it was projected to go down the next 5 years. Number of shares had increased the last 3 years. It was expected to increase the next 5 years. So they're basically they're diluting the share pool, and the earnings per share went down, which is when you have more shares, obviously.
And the combination of those two actually make it even less valuable over time.
So I got out of it. I literally just got an email yesterday about how it's a good buy, and I was like, "Oh, you guys are way behind. Like it's overvalued right now. You need to get out of it. Wait for it to pull back." So that is an example of how, not being a professional financial planner, I can actually say, "Hey, get out of that stock." Because it's everyone's getting into it because they're all like, hey, this is a great stock to get into.
Well, another great example you were just talking this morning was Triple M. You said that email you got in said, we can't recommend this yet. We're waiting for X, Y, and Z to happen.
They're waiting for the 2025. They expect by the time February of 2025 rolls around, Triple M will either have increased their dividend for this 67th straight year, or they'll have cut their dividend. They said if they cut their dividend, they'll recommend it as a buy. But I've bought that months ago, when it was like $82 a share, and it's like I think it's back up to 100. It was like 116, and then they did the spinoff where they got rid of the pharmaceutical healthcare component, and it went back down to 93, and now it's back up to like 98.
So Tim got it during that dip because he was like, hey, this is undervalued. That came up on his radar. And then this other company's over here saying, we're not going to recommend this until however long down the road, which at that point, it very well could be overvalued because everybody else is buying it while it was dipped down. And then they're going to recommend it to the general public, which then again is going to push it up even further overvalued.
I see that a lot in my research, where like stuff that I've had, they recommend buying, and it's like I can see that it's on the way down, but I'm holding it because I'm accumulating shares. I know one that they've mentioned last 2 weeks ago was IIPR, which I got into IIPR months ago again because it was super undervalued. I got it for like $88 when it should be trading at like $120. It's at like 100 right now. And they're saying IIPR is a good time. It's a good value to get into, which very well it could be. It could go back up to 120, so you're making 20%. But it had, and you listened or subscribed to the email, I actually recommended getting IIPR. I think it was 6 or 7 weeks ago. So this is way undervalued. It yields like 7%. It's the best one on the list. Had I been doing this 5 years ago, I was not very good. But through the last 5 years, I've learned a lot, and I'm actually really good at getting undervalued stocks now. Super good.
And that's that safety of margin cushion in your portfolio, which is excellent. And then it keeps you from having your dividends getting eat up by buying in at the wrong time. And if you get on top of some of these resources and get on our email list, you're going to, the combination of things.
This week, the email coming out is about popular stocks. Tesla's on there. And what happens is when the experts say buy a stock, all the people in Robinhood pile into a stock, and it makes it one of the popular stocks. The top 10 popular stocks are actually down 20% for the year.
Going with the herd, losing money. That's essentially the gist of that whole thing.
So don't ever listen to what the experts say. Just use the experts for a good potential research starting point, and then do your own research. What I tell you when I use these sources that I've just outlined, what ultimately ends up happening is you'll get a recommendation for XYZ. What'll end up happening is when you type in XYZ, you'll see like 4 or 5 competitors of XYZ that have better EPS, better yield, better PE. Then you'll start veering off from XYZ to one of its competitors, and you'll find, hey, that one's undervalued. That's 9 times out of 10 when I buy stuff, it's from one of these resources saying buy this other stock, and I do the research. And I'm like, well, this other stock's better than the one they're recommending.
Way better. Okay, so for next week is probably going to be a really, really interesting episode for those of you who are getting started or you're not sure whether you should have a retirement account or a regular brokerage account. We're going to actually walk through what situation you're in and which way or percents of your income or percents of what you're trying to invest should go in which accounts and why. So we'll cover like Roths, we'll cover the 401ks, we're going to cover regular savings accounts, the retirement side, or the traditional brokerages. So we're going to lay that all out, give you a couple examples. Like if you work with a company that matches, yada, yada. We'll give you certain circumstances, and age is going to factor into some of that. So we'll outline all that next week. That's going to be a great episode, so make sure you tune in. Do you have anything else to say about this episode? I think we're pretty good. Just those two resources.
I think I'm going to butcher what the writer of Sherlock Holmes said, but basically he said, if you don't research, you're making illogical choices.
Facts.
And that pertains to every aspect of life. The more you know, the better decisions you make. So that's why I was like,
and the slower you make decisions, the better decisions you
here's all the resources I use. So you could be just as cool as me, or you can just use me, whichever. I don't care.
We are totally giving you that opportunity, an option to pick Tim's brain every week on the emails. And then once we get the social launched off, we're going to be doing stuff over there as well. So if you guys have questions, you can always hit us up on any one of our socials or shoot an email directly at Tim, and we'll create a special episode just for you. We'll see you guys in the next episode.
Yeah.